alaikum, and a very good day to all viewers out there. Welcome back to my slide presentation on MFRS 3. This is video number 3 for MFRS 3. There were two earlier presentations that I have already uploaded. And I'm going to proceed with the illustration of how to compute consideration transferred and dealing also with the accounting treatment of consideration transferred. In the video before this, I have already gone through the question, and what I'm going to do now is I'm going to respond to the requirement of the question, which is to compute the consideration transferred to the investee daughter, which is the investee company here, and mom is the investor company, right? So what happened is that mom acquired 60% out of the shares in daughter. So that is the reason that daughter is an acquiree of mom. Okay, so let's look at what we have here. One of the important items or important thing is the control percentage. Yeah, this one assuming that the company has acquired control by just having the majority of the shareholding, 60%. And if you can see here, these are the consideration that are being transferred. The one here, consideration transferred. We have already discussed this. And let's look at what are the consideration transferred. The first one is the cash. Second one is the shares, right? The third one is the debenture. And there were also some costs related to issuance of debenture as well as the professional fees. Let's look at how to work it out. So I'm going to put the question again here next to each other. So if you can see here, the calculation of consideration transferred is our focus, this one. So consideration transferred is our focus. So we're going to calculate that as happened on the date of acquisition. So this is the date of acquisition. Date of acquisition. So you have a cash payment of 10 million, right? So that has been included here. And then there was a share exchange where you acquire 60% and you are going to issue a share of 2 for every 3. So 2 for every 3. So I'm putting it here because 60% from 10 million, 2 for every 3. And the issuance price or the fair value should be the fair value or the market price of shares in mom, which is 3 ringgit. So it's 3 ringgit, 3 ringgit, right? So you will have 12 million. And there was also an issuance of debenture amounting to 600,000. So that is what happened on 1st of October. So you will get 22,600. This is the total consideration transferred on 1st of October, year 2000x8, right? 2000x8, and this is on the date of acquisition. So let's look at the next one. The next one is that this is the full, bigger version of the answer. The acquisition related costs that you have, which is the professional fees, if you can still recall the lecture, it is a directly attributable cost, and therefore that will be expensed off in the profit or loss. It will not be included in the calculation of consideration transferred. That should be expense of. And now we're going to do the journal entry. That is the requirement. So to do the journal entry, I put again the workings for consideration transferred here, because this is what we're going to journalize. And of course, with the journal entry for the professional fees as well as the issuance costs of the debenture. So you also need to consider this. Next. So these are the journal entries. If you can see, the total here is 22. So you need to go and debit your financial asset, because this is an investment done by mom, which is the acquirer, yeah, and daughter is the acquiree. So credit bank with the consideration transferred 10, 12, and 600,000. So you have to include it here, right? That is what happened to recognize the consideration transferred for the business combination. And this will give rise to investment in daughter. That is the business combination where you invest in daughter by acquiring 60% of the voting shares. The next one is to recognize the acquisition related costs for the business combination. For the professional fees, it will be expense off to the SOPL. So professional fees earlier was 100,000. Debit professional fees, credit bank if you pay for it, or else you will have to credit accrued professional fees. And the debenture, if you see earlier, you issue the debenture, and the issuance costs will be now offset against the amount of the debenture that were earlier issued. So therefore, debit the 5% debenture to reflect the issuance cost, which is to reduce the carrying amount of the debenture, and credit bank 110,000. Right. So that was the journal entry. Let's see what is the impact in the financial statement of mom. Right. There is no consolidation that has taken place because we have not even dealt with MFRS 10 yet at the moment. So this is just the journal entries relating to acquisition of investment. And these are the bigger version of it, right? But bigger version of it. And let's look at the impact in the separate financial statement of the acquirer. Remember during lecture, I did mention that apart from later, if the accounts are being consolidated, the acquirer will have to prepare the consolidated financial statement. But at this stage, there is no such thing yet, because at this stage, acquirers are recording the investment in the acquiree daughter. And that investment in the acquiree is treated as a financial asset, right? And that will be disclosed under non-current asset. So that will be put as non-current asset, a financial asset, in the separate financial statement of the acquirer. So immediately after the acquisition, if Mom Berhad prepares financial statement, it should show the investment in daughter there. So there is no goodwill that will be shown, right? And there is also no bargain purchase as well, because this will only arise if there are consolidation. So there is no consolidation that has taken place as yet. Okay, these are the extract statement of financial position of mom, showing the non-current asset, equity, and non-current liabilities immediately after the acquisition of daughter. In the non-current asset section, you will see the investment, which is a non-current asset, being located here. And this is in the separate financial statement of the acquirer, 22.6 million. And you have your equity, where ordinary shares now has gone up by 12 million. Before this, there was 50 million in issue in Mams Berhad, and now it becomes 62. million. For the 5% debenture, at first it was 600,000, and we reduced it with the issuance cost of 10,000. So it is now 590,000. Okay, you can go and check that again yourself. And now we move on to non-controlling interest. What is non-controlling interest? It is actually an equity. Equity where in the subsidiary company that is not attributable to the parent, either directly or indirectly. Either directly or indirectly. So non-controlling interest, or better known as NCI, is a term used for the shareholders that do not control the company, do not make decision of the company, do not direct the activities of the company, and therefore they are called the non-controlling shareholders. However, this only happens if the acquirer acquires less than 100%. Let's say acquirer acquires 80% of the shares. So if acquirer have a control of 80%, so the non-controlling interest would be 20%. So that is what you should understand. However, if let's say it is a case where you have an acquisition of 100% of the shares, so if there are, let's say, 100% shares acquired by the parent company, so therefore there is no percent that are related to the NCI, so the non-controlling interest is nil. So if less than 100% of the equity shares of another entity is being acquired, then only non-controlling interest is being recognized. So let's look at the accounting treatment of the non-controlling interest. So in the consolidated statement of financial position, the non-controlling interest will be identified. You're going to identify them, you're going to calculate them, and you're going to present this equity. Remember I mentioned this is equity, as equity, but it must be separately presented from the parent's equity. So the non-controlling interest in the net asset that will be disclosed in the statement of financial position, the consolidated statement. So meaning that this will only arise if there is a consolidation. When the parent has already acquired control, they need to disclose also the interest of the non-controlling shareholders. Right. So this should be the amount of NCI that is recognized in accounting for business combination, meaning that the one on the date of acquisition, the one that arise due to the control being acquired on the date of acquisition, on the date control is being established. And it should also include the non-controlling interest share of recognized changes in equity. Recognized changes in equity, recognized changes in reserve, right? So we need to also look at what are the share of the non-controlling interest in the reserve of your acquiree. So either the retained profit reserve, like a general reserve, etc. Right? And that should be recognized since the date of business combination. There is a choice actually in each business combination to measure the non-controlling interest. There are two options given. One is at fair value, and the other one would be at proportionate share of the acquiree's fair value of identifiable net asset. That will be discussed in the next slide. Okay. Non-controlling interest is recognized and measured on the acquisition date. Let's see, just now was 1st of October 2008. There was 60% of shares being acquired by the acquirer. So meaning that 40% is being acquired by the non-controlling shareholder. So let's say we assume non-controlling interest is 40%. And how do you measure the amount of the non-controlling interest? So it should be an option between these two that you have here. At fair value of the shares held by the non-controlling interest, look at what are the shares held in the subsidiary company, and therefore the non-controlling interest shares will be based on the fair value of the shares held on the date of acquisition. And in this method, what happened is that it will recognize both parent and non-controlling interest share of goodwill. So we're going to look into this in another few more slides. So this is full goodwill. So when you measure it at fair value, you will come out with full goodwill. The second one, this is the first one, this is the second one. You have another option, which is to measure it equal to the proportionate share of the fair value of the net asset of the subsidiary. So you need to know what are the fair value of the net asset, and later that will be the basis to measure the non-controlling interest. Let's say the fair value of the net asset is 100,000, and your controlling interest here is 40% by the NCI interest. So if you multiply by 40%, you have 40,000. So that is the measurement under the second method, which is proportionate share of the net asset. And this will give rise to the partial goodwill. So if you measure it at fair value of the net asset, so that is using the net asset here. The first one is using the fair value of the shares. So if that is the case, you are going to measure it, and that will give rise to partial goodwill. So the different methods of measuring accounting for the non-controlling interest will give a different amount of goodwill. Let's move on to goodwill now. What is goodwill actually? We are talking about now purchase goodwill. We're not talking about goodwill which are internally generated, which is not recognized under MFRS 138 or IAS 38, which is intangible asset. You're talking about the goodwill as defined by MFRS 3 as the asset. It is defined as an asset that represents the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So the goodwill here is being recognized because it is through acquisition in a business combination. Remember, we invested in daughter just now. So once we consolidate the result later, you may notice that a goodwill may arise, yeah, if the computation have been correctly done. Goodwill on consolidation will arise when the equity or the fair value of the net asset of the acquiree, fair value of the net asset of the acquiree is less than the fair value of the acquiree's equity shares held by all equity holders. Or simply put here, we are talking about consideration transferred by the parent plus the non-controlling interest that you have already measured. So this would be the this will give rise to goodwill. Next. And there is the premium paid to acquire the shares, and it will only arise during the consolidation or in the consolidated financial statement, CFS. Goodwill will not be amortized. That is not allowed under MFRS 136. Yeah, and it is only subject to an impairment test under the provision of MFRS 136 impairment. So under MFRS 3, the acquirer shall recognize goodwill as an asset on the date of acquisition if the goodwill is having the situation where you have excess of A over B. Before this, I've explained in the previous slide. But what is actually A? A, number one, is the consideration transferred. What you transfer to your acquiring, right, to get the control, and what you transfer on the acquisition date. The second one is the NCI, non-controlling interest. How much is the amount of the non-controlling interest that has been measured? The third one we will not discuss because this is outside the scope of our syllabus. But the third one is on fair value of the previously held equity interest. But we will not discuss on that. You will discuss that further should you go and deepen your understanding of MFRS 3 in your maybe your more advanced study. So the net acquisition, so that was actually A. So A is whatever here. B is where you have the net of the net acquisition date fair value. So fair value of identifiable asset acquired and liabilities assumed. So look at the asset that were acquired, look at the liabilities that you have incurred, what are the different, and check what is the fair value. So if you have that, this is actually a number. This is B. This 2 is actually part of A. So if A is greater than B, you will have a goodwill. Right. In terms of accounting treatment, it shall be accounted for in accordance with MFRS 3, where it will be recognized according to two options, depending on how NCI is measured. So goodwill, if you have the first option, which is partial goodwill. Okay, if you recognize this as a partial goodwill, this is because the non-controlling interest is measured at the proportionate share of the fair value of the net asset. So if your non-controlling interest is measured at the fair value of net asset, you will have a partial goodwill. Yeah, the calculation will give rise to partial goodwill because under different method, you will have a different amount. The second one is the full goodwill method. The first one is the partial goodwill method. The second one is the full goodwill method, where full goodwill method means when non-controlling interest is measured, that is fair value of shares held by the non-controlling interest. So this is where the non-controlling interest is measured at fair value, you will have full goodwill. And if you look at the second method, the share of goodwill that you recognize is full goodwill, which means that not just the parent share of goodwill is being recognized, but also the NCI share of goodwill is being recognized. In the first method, only the parent share, parent share is recognized. Non-controlling interest share is not recognized. Next. These are the summary of what was explained in MFRS 3 on calculation of goodwill. So consideration transfer, that was explained in number 1. Fair value of previously acquired interest will not be within our discussion. As I said, this is not in this course syllabus. So you're going to go and find what are the consideration transferred find the non-controlling interest, but make sure you measure the non-controlling interest correctly. Either you measure it at fair value or measure it based on the net asset, because you need to select one of the two options. So if you have got that, right, and let's say you have a total here, and the total here exceed B. What is B? Fair value of the net asset in the acquiree. So fair value of the net asset, let's say here is 15 million and here is 5 million. Sorry, let's say here is, just put a greater one. Maybe I put this 45 million and this is 5 million. So if that is the case, what you would have here, maybe this one 40 million is the goodwill, right? So the goodwill, because A exceeds B. Next. For more detail, go and check out example 9. Work through it yourself. I'm not going to do this with you. You can work it out at your own time. Work it out at your own time and work through the entire solution given in the example. This is the accounting treatment for goodwill. As I said, you cannot amortize. The standard says that actually. And somehow the standards mention that goodwill must be tested for impairment. So if the goodwill is tested for impairment, if the goodwill is being tested for impairment, what happened is it has to be tested for impairment annually, annually, or more frequently if there are indicators that shows that the goodwill may have been impaired. So this is similar to the impairment done in the context of IAS 16, MFRS 116, IAS 38, MFRS 138, which is impairment of the non-current asset. Right? Only that here there is no amortization. So impairment loss will depend on whether you adopt again the partial or full goodwill. So here partial goodwill, here full goodwill. So if partial goodwill, remember only the parent share of goodwill is being recognized. Under the full goodwill, you have the parent as well as NCI share of goodwill that they are being recognized. So if that is the case, if you have an impairment loss of, let's say, 100,000. So if this is using partial goodwill method, this impairment loss, I put IL there, of 100,000 will be debited directly to the statement of profit or loss of the parent. P is for parent. And it will be credited in the you are going to credit your goodwill. This is the shortcut journal. Goodwill with 100,000. If this is the impairment loss. However, if you have here, you recognize full goodwill, and let's say the impairment loss of the full goodwill is also 100,000. The journal entry, it says that you need to write off against parents' profit and NCI as well. Here it says write off against parents' profit. That's why it's here. Therefore, you will go and debit to the SOPL, statement of profit or loss of the parent, and you also need to debit to the non-controlling interest before you go and credit the goodwill with 100,000 due to the impairment. So if that percentage that we use in our daughter mom example, 40, 60 percentage by parent, percentage by NCI. So it means that here will be 60%, here will be 40%, and therefore 60,000 and 40,000 respectively will be debited to the parent's profit and non-controlling interest. So again, goodwill, for your information, if it's in the consolidated financial statement, the goodwill is disclosed in the consolidated statement as an intangible non-current asset. So you're going to disclose what? Disclose the carrying amount. You are going to disclose the carrying amount. The carrying amount here means it is the cost of the goodwill, the cost, right, minus the accumulated impairment loss if you have been doing impairment for more than once. So you need to go and deduct the accumulated impairment loss. Okay, next. What is bargain purchase? Bargain purchase is the reverse case, is where you have B, which is the fair value of net asset, B, exceed A. A, what is A? Remember, consideration transferred and non-controlling interest. If you add them together, that amount is what you call A, right? If A is less than B, that will give rise to bargain purchase. Bargain purchase will be recognized on the date of acquisition. In terms of accounting treatment, it will be treated as an income in the statement of profit or loss of the parent. And after that can only be done after the reviews and the remeasurement of the bargain purchase have been done. In our case, we assume that has been done. So if there is a bargain purchase, the accounting treatment, assuming this has been done, will be credited to the statement of profit or loss. So these are the review that should have been done. You can read this yourself, meaning that you need to make sure that assets are all correctly calculated, measured. Non-controlling interest is also reassessed and measured. And the consideration transferred is also being correctly measured. And remember, this one, as I said, is not in the syllabus of our syllabus, but this can be the case done for your advanced study, the previously held equity interest in the acquiree. Okay, example 2 is the computation of goodwill. Be very fast because you can work it out yourself. So it's a 60% equity shares of ANA on the date of acquisition. Look at the date of acquisition closely, 1st of January. The consideration transferred were, this is the asset transferred, the consideration transferred, this is CT, I put CT, cash, this is an asset, and you also involve a liability because you have a deferred payment of 5 million and the present value of the deferred payment is 4.4 million. So the 4.4 million will be included also in the CT and will be together with the cash. CT is consideration transferred and the acquisition cost 200,000 must be expense off. Do not include in CT. Remember, you have two information, a very simple one because we want to make it quick. So you are given straight away what are the fair value of the net asset. Remember when we talk about an NCI, I mentioned that it can be measured either using fair value of a net asset or maybe using the fair value of the shares in the subsidiary or acquiree. So under the fair value of the net asset, it is measured at 22 million. non-controlling interest at the fair value is 9 million. So this one is a different measurement that you will use later, right? Depending on what is required. So what is required, you ask to calculate the consideration transfer. We can do this very fast and calculate the non-controlling interest. So this one will be the same regardless whether full or partial goodwill method. The consideration transfer will be the same. But if you look at the non-controlling interest, you are asked to calculate that under full goodwill, as well as calculate goodwill under both methods. So we are going to calculate that under full goodwill method and partial goodwill method. So I put some colors there. If you notice, the green is for the fair value of net asset. The yellow is where NCI is measured at fair value. Under the full goodwill method, you can see the light blue there, turquoise, where you have the consideration transfer. Remember, there was two element of consideration transfer, or two component. One is the cash, which is the asset. Another one is the liability. This one is asset. So the deferred payment, 4.4 million. So that will made up 14.4. Non-controlling interests will be measured here. This is using full goodwill. So the fair value of NCI given in the question was 9. Go and check it. I put the yellow highlighter earlier. And the fair value of the net asset and acquiry, I put the highlighter as well. I think that was a green highlighter. Yes, I think so. Yes. So the fair value of that and is 22. The net asset is not given. They give you straight away the fair value. Somehow you may have to compute this. It takes time to do that. And you have the goodwill on business combination. This is the full goodwill. And you can see later what is the share of the parent and the share of the subsidiary. Right. Next, you can work through this. So I'm just going to focus on the consideration transfer is 14.4 is the same. Non-controlling interest will not be at fair value. What you need to do is you need to take the fair value of the net asset, or you need to calculate that if it's not given, and then multiply by 40%, which is the NCI percentage, and you get 8.8. So this is actually B. This plus this will give you this, right? So therefore, 23.2 is greater than 22, which is the fair value of net asset, and you have a goodwill on business combination of 1.2. And you will see that there are different in terms of the valuation of goodwill under both methods, because you have a different NCI measurement. So you need to make sure the goodwill is being measured correctly. So we are coming to the end of the slideshow for this MFRS 3. And under this standard accounting for business combination, you need to use a lot of fair value estimate. That's why fair value for the NCI, fair value for the net asset, and this will normally requires judgment and estimates. And sometimes you may also notice that some intangible asset may have been recognized separately apart from having goodwill. Other intangible asset like patents, trademark, they are recognized separately because maybe that arise on the day of acquisition, and perhaps before this, those assets have not been recognized yet by the acquiree. So we have to recognize on the date of acquisition as the acquirer. In terms of disclosure, this MFRS have a very comprehensive disclosure requirement, because it is the intention is to let users to have the better evaluation about the nature and financial effects of this important business combination. For more details, go and refer to MFRS 3, which is looking at the appendix, which is the integral part of the MFRS, appendix B64 to B67. With that, I've finished with this MFRS 3 slide presentation. In the next video, you are going to work through with me MFRS 10. But as for today, thank you for watching. Thank you for your